So this was, Steve, in comparison to the previous quarters we've covered, when we've said growth was going to slow down for Nvidia at some point, but we wasn't going to bet when that was. It finally seems to have happened, Steve. Growth for Nvidia in this second quarter of obviously 2026 was only up 6%, Steve, sequentially. It was up 56% year over year to $46.7 billion. That became about $28.4 billion in EBIT. That was up 53%. For the people with calculators in the hand, that's a margin of about 61%. Net income, $26.4 billion. That's up about 59%. That's a margin of about 57%. And they generated about $15.4 billion in operating cash flow. That was up about 6%, margin 33, $13.5 billion of free cash flow. That was super flat and a margin of about 29%. If you'd like it by segment, data center, $41.1 billion, up 56, and that breaks down into compute, which was $33.8, up 50, and networking, $7.3, up 98%. Gaming came in at $4.3 billion, up 49%. Professional visualization, $601 million, up 32%. Auto, $586 million, up 69%. And OEM and other was $173 million, just up 97%. So yes, very, very strong set of earnings there. Really everything looking very, very healthy. They were keen to point out that they now have a backlog of just under $46 billion. These are full purchase commitments moving forward, so it's essentially another full quarter's worth of revenue already committed. And they guided for the next quarter to be about $54 billion in revenue. That's up 54%, and you've got to assume that will include no H20 shipments to China. They think the GPM will be about 73.3%. That'll be up about 80 basis points quarter on quarter. And they reckon full year OPEX will be about 40% there or thereabouts. In terms of the call, they were keen to stress that it's a record quarter for them, $46.7 billion in revenue, exceeded expectations, strong demand across all market platforms, including cloud service providers, enterprises and sovereign nations. The networking revenue was also a record at $7.3 billion. This is a 98% year-over-year increase. This was driven by demand that Steve and I talked about a couple of quarters ago. But Spectrum X, Ethernet, InfiniBand, and NVLink are their technologies, and they all look like they're doing really, really well. In terms of AI infrastructure and future growth, they said that AI infrastructure spending will reach about 3 to 4 trillion by the end of 2030, they reckon, with an annual spend of about 600 to 800 billion. The company sees this as a long-term growth opportunity, with current top hyperscalers alone spending about 600 billion annually with them. They reckon the further growth is going to be fueled by reasoning and agentic AI, essentially this next generation of AI. It requires significantly more thinking or long thinking processes, and they reckon that's going to increase the computation needs by around 100 to maybe even 1,000x compared to what the current models do. They said that nations are investing very heavily in their own AI infrastructure. They're on track to achieve about 20 billion in sovereign AI revenue this year, which is double last year's figure. And the EU has also told them that they're going to spend 20 billion establishing 20 AI factories. And the UK is going to spend £7.80 on the new Eisenberg AI supercomputer. Enterprise adoption and robotics. About 90 companies at the moment are adopting NVIDIA's RTX Pro servers for various applications, which the company thinks is going to become a multi-billion-dollar product line. They've got a new robotics platform that they're calling Jetson, which is also available, has 2 million developers already and 1,000 plus partners already using the platform. In terms of technology highlights, they said that the Blackwell platform is the key driver of growth. The GB200 and the GB300 systems have been established as a standard, essentially, for AI inferencing. The GB300, combined with NVLink they reckon is about a 50% increase in energy efficiency per token compared to the previous generation. They've spent about $3 million investment in GB200 infrastructure, and they reckon this can generate about $30 million in token revenue, which represents roughly a 10x return, essentially. In terms of production shipments of the GB300 began in Q2. Widespread availability expected probably in the next quarter, but maybe in the quarter after that as well, but definitely the second half of the year. They're essentially transitioning to rack-based architecture, which they say has been seamless for the major cloud service providers. Some innovations as well on the software and hardware front. They reckon the software alone has improved Blackwell's performance by about 2x since it's launched. The company is committed to an annual product cycle, so products like Blackwell and Rubin are designed to maximize revenue generation for customers by consistently improving performance per watt and per dollar. In terms of geographic news, China's revenue declined sequentially to low-digit single percentage of data center revenue. H20 shipments not included in any of this outlook. Nvidia thinks China is a significant opportunity, estimating it will be around a $50 billion market this year if they could address it. China, they reckon, currently has about 50% of all of the world's AI researchers, and it's just a market that they're just not allowed to touch. They said Singapore accounted for about 22% of build revenue in the second quarter, but over 99% of this was for US-based customers who've centralized their invoicing there, which you'll probably be able to figure out why that is. Acquisitions and strategies. Nvidia's acquisition of Mellanox about 5 years ago was crucial for its networking capabilities. They said it allowed them to provide full rack solutions rather than just chips. The company thinks that full stack solution, basically hardware, software, and networking, gives them an even stronger competitive advantage than they already have. They said that all of their products, including the H100 and the H200, are currently sold out. And large CSPs are even resorting to renting capacity from each other to basically try and meet demand. So hopefully that gives you an idea of... They don't think the growth is stopping quite yet, Steve, and these cloud service providers are very, very hungry to keep expanding. So it will be interesting to see where we go from here. But that was essentially the earnings and the call. I thought it was incredible again, Steve.
Yeah, I did as well. I'm getting... it's weird things are happening to me with Nvidia. It's one where I'm getting irrationally cross, and I'm also not necessarily thinking as clear-headedly as I might about the stocks. So let me say a bit more here. Nvidia has, as I look at it at the moment, a market cap of 4.28 trillion, which is obviously massive. And people are rightly pointing out, well, they're wrongly saying the law of large numbers has to kick in sometime soon. They're wrong about this because that's not what the law of large numbers says. But it's the thing that everyone calls the law of large numbers. So let's call it that for the moment. Okay, so the kind of thing that's meant to be impressive here is that this thing has a market cap of 4.28 trillion. And it's still growing sales at 56% year over year. That is slowing down kind of gradually, but hey, look, 56% year over year growth is 56% year over year growth. Except it kind of ain't. So the people who are getting excited by that are missing what I think is a pretty obvious point, but good people appear to be missing it, which is that 4.28 trillion isn't the number that's growing, it's their sales number, which is the number that's growing, which this quarter was 46.7 billion, I think. And that's growing at a rapid pace, and it's still pretty impressive here. But when you sort of look around elsewhere in the stock market, Google, company that we know and quite like a bit, well, their Q2 sales were 96.4 billion, so they're more than twice Nvidia's here, which means that Google's market cap, by the way, Alphabet's market cap here, 2.53 trillion. So it's about 1.7 times as expensive as Google here and has just under half the sales. And kind of given that, you might well be thinking, actually, we're priced for quite a lot of growth here. Still, this thing really does need to grow. I'm going to pay nearly double that. Nearly double what I'm going to pay for Alphabet for around about half the sales, which makes it look kind of expensive. But, and here's the kind of but with this, Revenue growth is slowing, but it's still at 56%. Google has been sort of consistently around the 13-ish, 13.5% mark for the last 6 quarters or so. A little bit above, a little bit below, but fairly consistent around there. And you get the impression eventually Nvidia will drift to that level at some point as it slows down. But as the quote-unquote law of large numbers, which isn't the law of large numbers, kicks in. Thing is, though, more the revenue growth slows down, the more I actually quite like it. Because the more this thing seems to start re-rating towards multiples that I can kind of get my head around here. So I'm looking at the price-to-earnings ratio now, which I know is not always the right number to use to measure a tech stock, but when there's things like stock-based comp swilling around, it's not always the worst either. It's trading at about PE ratio 50, looking backwards. If you think that's still got a few more goes of 50, 40, 30% sales growth here, that's not earnings growth. You will get some margin expansion, maybe a bit of a reducing share count. We'll see on this. Last I heard, they were doing buybacks, but I think there's still some way to go before that starts really meaningfully cutting into things and firing returns. That doesn't look kind of crazily priced to me at the moment. The China thing looks like a bit of a mess, and it creates a fair bit of uncertainty, but it's not a huge amount of the overall business. And it does look to me like a good illustration of exactly what a headwind an annoying government can be, whether that's the US or the UK or some emerging market or anywhere you like in this case, because they've gone from being banned from selling chips to China in April to allowed to sell them with specific licenses in July to now in a revenue sharing thing, I think, with the US government where they can sell H20s to China, but only if they give away 15% of their sales price to the US, which is basically a way of, I think, turning them into a sovereign wealth fund without having to actually buy any shares, from what I can tell. Because that's quite a nice arrangement. You collect a sort of 15% sales dividend on the China part of the business, and your outlay is nothing in a week where I think the US bought a massive stake in, or decent sized stake in Intel for part of their sovereign wealth fund. Exactly why we shall see, no doubt, further down the line. But I kind of like this the more I see this going, and I ought to like it less and less because I don't love slowing sales growth, even if it's slowing to 56 and there's still a big market cap that's way bigger than kind of comparison things. It's growing faster than Alphabet. It needs to grow faster than Alphabet. It's growing off a much lower base than Alphabet is. So it's not like it's punching up sales numbers the like of which the world has never seen before in anything at all. But that, to my mind, is maybe an advantage for it in the sense of we're not in uncharted territory and still needing to grow at 70% a year or something in order to make the maths work out here. So I think sort of reasonably positive on all of this. And the H20s, of course, are a kind of earlier version of a Blackwell. They're Hopper chips, as I understand it, rather than Blackwell, which is their newest thing. And they're busy trying to figure out exactly how much they have to try and degrade their Blackwell chips in order to let the government sell them to China. The things that people kind of get on with of how much worse do I have to make my own product here. But overall, yeah, very impressed, Steve. I feel like, not on a share price basis, actually, but I feel weirdly anchored to previous growth rates and thinking I must have missed out here because, well, in Q1 of last year, not the one just gone, the thing was growing sales at 208% a year. Now it's only growing them at 56% per year. I must have missed all the fun. Well, maybe, but maybe not. Might be worth a look, Steve. What do you think?
So while you was talking there, Steve, I just ran the numbers through the reverse DCF, and I guess I'll pass it back to you. So just to let you know the details that I've got in to give you a chance of guessing, but 72 billion in free cash flow trailing 12 months. That's just taken straight from Yahoo Finance. I've done terminal growth rate at just 2%, discount rate at 10%. And I've done buybacks of just 0.1% of the share count every year, which I don't actually know if they'll achieve that or not. But any guess what kind of growth rates you need to make today's valuation match over the next 10 years?
That was what I was going to ask. Over 10 years, but terminal growth rate of 2%. Okay. Well, remind me the last bit again. You said closing multiple. Did you say on that?
Just know what you think the growth rate would need to be to make the valuation match today.
20?
Yeah, not bad. 23, essentially. It's
Hmm.
23.1 would be a good match if you think those inputs are. I mean, I think personally the terminal growth rate at the end there at 2 is nonsense, but you have to put something in. And even so, that will leave you with a terminal free cash flow value, Steve, of 575 billion in free cash flow, which, Christ, I mean, they're kind of numbers that I don't. Anything can happen in 10 years. But if you're asking me if I'm going to bet that a company's going to do 500 billion in free cash flow in 10 years, I'm always going to say I wouldn't bet against it, but I wouldn't bet for it. And I think that's kind of where I land with Nvidia, and where I think Steve and I have landed throughout the whole thing. It's like one of those companies that we love to sit on the fence and watch and congratulate others for doing well in, but maybe, just maybe, it's a little bit out of our wheelhouse is maybe the right term, but also maybe a little bit out of like just well what we would sit on the side of sensible, I guess, on this, and say we just don't think that number's possible. But then also on the flip side, not be surprised at all if it got there. So I think that's probably where I would land on it. Steve, do you have anything to add on that before we move on?
Sensible is the word, isn't it? I feel like either way, I make a case for it, I make a case against it, and I kind of have a sense check, just to make sure what I'm saying here makes sense. And neither way round does it really work in this situation. So one way round, the case against goes from saying, before this quarter, looking at about 150 billion in annual sales, and within 10 years, we're going to be making 3.5 times that in free cash flow, not sales. That sounds kind of insane, as a way. That sounds like my thing that holds back my sense check on the buy side. On the other hand, however, when I say no, it can't possibly do this, I look at it and say, well, it's got a lot of room to grow until it's even the size of Alphabet in terms of sales at the moment. It's quite a way out in the distance. It is growing very, very quickly. Why could not this thing achieve 23% when it's currently doing sort of 56 in sales alone? And that's not kind of giving you anything for margin expansion or buybacks, bringing down the share count or whatever. There's other kind of levers they can eventually pull. I don't think they're massive growth levers in terms of margin expansion and so on, but there's potential scope for things to look higher there. So why is 23% such a ridiculous idea over 10 years? Don't know. To be honest with you, it seems like either way round, I run into a sense check that stops me from doing anything, and I think you have a mug for this kind of situation, Steve. You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.